Hello everybody and welcome to the Property Podcast. This is episode 254 and we are bringing you a mortgage update. Let's face it, if you're a property investor, mortgages are probably going to be pretty important to you at some stage or another. So this week we've got our expert back on, Dave Cookson, who's going to take us through all things mortgages.
Yes, indeed. Welcome to the Property Podcast. Always so great when we're joined by experts, and we've been so spoilt this year already. We've been joined by Russell from Property Hub Tax twice, and now we've got Dave bringing us up to date on mortgages. So there'll be loads of essential information in today's episode. We've also, of course, got a news story, and would it shock you to learn that that's to do with the government taking more action against landlords? And we've got a resource of the week that might see Rob B getting some flack from his buddies back up in Liverpool.
But before we get started, I'm not happy, Rob. For the sharper listeners, they may have noticed that you actually weren't on last week's podcast. Where were you and what were you doing? What could be more important than a property podcast?
Well, first of all, I'm gutted because I was the first one to blink. I was the first one out of the two of us to miss a week. And it's the first week that we haven't had both of us on in just under 5 years. So I was very disappointed about that. But my disappointment was tempered somewhat by the fact that the reason was that my wife was having a baby that day. So I think, Rob, that's a reasonable enough excuse because if nothing else, I've generated a future listener for us.
Well, when you put it that way, okay, I'll forgive you. Yeah, congratulations, Rob. Yes, I'm sure your inbox is now going to be a little bit fuller this week with some people sending you nice emails, and so they should. Well done. Great news. We could end it there. That'd be a nice episode in itself. But as we said, we've got Dave coming up. But before we do, the news story of the week, Rob, looks a little bit scary from the headline. But actually, for good landlords, it should be okay.
Yeah, so the headline is Tenants Given Right to Sue Landlord. Just when you thought nothing else could come our way, now we're going to start getting sued by tenants. So the idea is this is a private members bill that someone's been trying to get through for quite some time. It's not actually become law yet. It's still going through the process, but it's now got the backing of the government, so it's more likely to happen. The basic idea is that if a tenant is living in a home that is not fit for human habitation, then they're not able to not only seek redress through all the channels that are already available, but they're also going to be able to take legal action and sue the landlord. Now, on the one hand, this does sound pretty scary. It's annoying enough when you've got a tenant calling you about a leaky tap or something like that and you have to get it sorted. If you're at the risk of them suing you about it as well, then that sounds even worse. But it's worth bearing in mind that this is about fitness for human habitation. And really, if you're renting a property that's not fit for human habitation, then you've got bigger problems as a landlord and you should probably expect action to be taken against you. So while details are thin on the ground, and it could be interpreted as quite scary, the comforting thing probably for landlords is that this is actually being backed by ALA and by the Residential Landlords Association. So if these landlord bodies who represent the interests of landlords are behind it, then I'm hoping it can't be that bad. But we'll find out more as it continues to go through the process.
Now, as Rob said, we've been rolling out the property superstars recently. We've been busy bringing in the experts to give you the best knowledge to start off 2018 strong. And bringing in Dave Cookson today is no exception. You've heard him before on the Property Podcast. We'll link to his previous episodes, which you can find at the show notes this week at thepropertyhub.net/2018 mortgage. But not only has Dave been on the podcast before, he's my go-to guy for all my mortgages. He also contributes in the Property Hub magazine. The guy is full of knowledge. We have to hold him back. There's so much stuff he gives us. So we've got loads of questions coming up. We cover limited company mortgages, we cover personal mortgages, and general updates as well. So without further ado, let's get him on.
So, Dave, it's been a while since you've been on the podcast. Thank you for joining us again. Things are changing in the mortgage market all the time. What are you seeing in the moment, especially with regard to limited companies? There seems to be a bit of a trend for more lenders to be getting involved. Is that still the case?
Yeah, without a doubt. I think we covered last time when we were on the podcast, TMW moving into the market, which is going to have a huge impact. We are predicting those numbers to grow again. We suspect BM Solutions will move into the limited company market. Last year was very, very interesting. If you're a bit of a mortgage geek like me, I suppose, in that we saw some quite dramatic falls again in the rates within the limited buy-to-let market. The movement, which I've just stated, of TMW coming into there, that the market has caused a stir in that that's had an impact on your traditional limited company buy-to-let lenders. your large ones such as Precise and such as Paragon, who have had another rate war. We've seen rates drop down to 2.99% in that market. Strange things happening in the limited company buy-to-let market, like they are incorporating additional features. So something which we traditionally see in the residential owner-occupier market and the individual/personal buy-to-let market. Additional features is where they are offering free valuations, cashback, free legals on remortgages. So yeah, overall, quite an interesting area of the market at this moment in time.
So you've mentioned products are improving, which is awesome, and rates too. That's what we like to hear. But what about the speed of service? I felt the pain personally on this one, and I know many other investors have too, that limited company mortgages can go on and on and on. So what's happening with the market? Have you seen any sign of improvement?
Precise have definitely improved. Paragon have gone backwards as far as I'm concerned. Kent Reliant are definitely improved. There is a long way for them to catch up to the personal and individual buy-to-let market in terms of service. We are still guiding our clients that if you are going for a limited company buy-to-let market, please be prepared to wait 6 to 8 weeks and don't be astonished if it goes past that. I touched on the rate war, which is going on, was quite heavy in 2017. I foresee rates bottoming out really this year. I can't see dramatic changes. We might see small decreases, but not like we've seen since 2016 when you'd expect to pay closer to 4% maybe on a limited company buy-to-let. Now, as I stated before, we've gone to 3%. So what that means is the lenders have to encourage clients and ourselves to use them for other reasons apart from the interest rate they're offering. And I would hope and predict that when we'll see service improve, they will focus on that as opposed to lowering their interest rates. The issue we have at the moment within that market, the reason the service is currently poor, is that there isn't a great deal of underwriters or staff available within that market. You've got to remember this market up until 2.5 years ago covered off around about 10 to 15% of the buy-to-let market. Within my own office, that's around about 85%. So, it's gone up by 70%. For the large companies such as Paragon, you've got to do a sustained recruitment drive to fill the roles. So I'm hoping this year will be the year that we will see service improvements. But I'm with you there. It's, as you're fully aware, Rob, it's a big bugbearer of mine as well. So fingers crossed, we'll see some improvements this year.
Yeah, I think we're all hoping that they beef up their HR departments and get that hiring done because it is such a pain point for everyone. What about things like types of products available? So, like, for example, with personal mortgages, you can get things like light refurb mortgages and things like that. Are there any sort of more interesting or innovative products coming out for limited companies?
Well, you've touched on the light refurbishment products. Saffron offer a light refurb. Precise offer a light refurb. The Precise product's quite a good one actually because they'll give you short term to term. So basically what that means is they will offer you a short term facility, i.e. property is not habitable, it hasn't got a bathroom in or a kitchen. So they'll actually lend you the funds to purchase that property on a short term basis. Pretty good rate as well, around about 7.5%. But the interesting thing about that product is what Precise will do is they will send the value around for the short-term finance, but then they will get the GDV on it. So you might buy it for 50,000 and it's a shell. Precise at that moment in time, unless they're surveyor, you will give them a schedule of work of which you're going to do. So I put a new bathroom in, etc., etc. That value will then say, that property's worth 100,000 on completion. And what will happen is Precise will use that valuation as guidance to put them on the long-term finance. So basically, let's say you're having short-term finance for 3 months. You then apply for the long-term finance and they will resend a surveyor out to make sure you've done the work. But as long as you have done the work and kept to that schedule, then they will refinance you at the 100,000. If you take it out, both the short-term and the long-term together, there are arrangement fees for the short-term finance, which I think is 2% in is wiped. So you're going to save quite a bit of money there. So that's quite a good little product on the light refurb side. I mean, as I've touched on before, we're getting the additional features, the free valuations, the free legals, a new thing in the market. We're seeing longer term products coming back into force. There is a stepped product with Paragon at the moment, which is pretty good. especially if we're looking in areas where we think rental might increase. So yeah, there's quite a bit out there at the moment. There's quite a bit out there. And I suspect, as we touched on with regards to the service and attracting brokers and clients to use the lenders, I think, the other side was they'll get more inventive with their products.
Dave, while we're on limited company mortgages, just a few specific questions that I know a lot of people have been asking recently, so we wanted to get it across to you for the expert's view. Starting with, how will personal circumstances, for example, existing mortgages, debt, dependents, etc., impact on limited company mortgages? How will that play out?
Your mortgages in the background is a good one. Dependents I wouldn't worry too much about. When we're looking at a limited company buy-to-let mortgage, the focus is on the property and also on the individual, but more so on the property with regards to rental stress calculations. However, since the portfolio landlord rules came into play, obviously this is where you've got 4 or more mortgage properties, they will start looking at the bigger portfolio, the bigger picture. So if I've got a client and they've got 100 properties in the background and they're looking to buy another property, it's a bit of a pain in the neck now, but we've got to submit that entire portfolio. And what the lender will specifically be looking at there is the LTV, whether that portfolio is sustainable. So i.e. if it's a 95% core of the portfolio LTV, then the lender can decline it on that. So debt is starting to play a factor, whereas in the past, on mortgage debt is starting to play a factor, whereas in the past, pre the portfolio and your rules, that would have been ignored. So it's definitely the biggest change. And I think at the moment, we're not seeing it have a huge impact on the lending for our clients, because a lot of our clients' portfolios are already geared to 75% LTV. That's just traditionally where the buy-to-let market is. And also we're in a market where property prices are rising or stabilising. I do believe that if we were to have another downturn and property prices were to fall, that will come into play, and that may well restrict lending, probably at a point in time when the economy will need us to be lending to support the housing market. So yeah, that's the biggest factor at the moment.
Dave, what are the practical implications of the portfolio landlord rules? Because it's not been around for that long. And when it first came out, lenders were coming out and saying, okay, well, we'll need a business plan, we'll need a projection, we'll need this, we'll need that. What are you actually needing to do in terms of paperwork? Is it slowing things down? Is it meaning a lot more work for your clients?
Yeah, it means a lot more work for our clients and a lot more work for ourselves. So as I stated, we are having to complete bespoke asset and liabilities lists for each individual lender, which wasn't too hard for us because we've always done that. But there is not one uniform asset and liabilities form, which is a pain in the neck. So, we might go to Precise. Precise is quite simple. We go to Aldermore's and it's 4 pages long. And yes, they're asking for business plans. One of the worst things is Barclays. We've just done one with Barclays. The client's got 38 properties in the background, all around the country, so uses multiple different agents. They want to see every AST, every tenancy agreement that client has got with his tenants. Then they also want to see the corresponding bank statement showing that income coming in. That is an awful lot of work to do. Like everything within the lending market, the lender has a knee-jerk reaction and they will go all out to satisfy the PRA, Council of Mortgage Lending Handbooks, until they realise it's impacting their business, and then they will ease up. So likewise, I know we did a podcast when the rental stress calculations came in, and we suggested that this would ease off in the near future. That's certainly starting to happen. They are still sticking on the individual/personal buy-to-let market to the 145%, but there are more and more lenders allowing top slicing now than there was 3 or 4 months ago. And just like that, as the industry gets used to portfolio landlord rules, I see it becoming simplified. And again, because the service has to be there. So they will find innovative ways to encourage lending from themselves. And I would hope they will target that area as being a major part, which is slowing the process down at the moment.
So moving on to personal mortgages. So much has changed in the limited company mortgage market, but what's happening with personal mortgages for buy-to-let? Are we seeing the same amount of lenders out there. Are they now scrapping around with what's left, and therefore are their rates and products improving because they've got less people going for those products? It's something that we've not really talked about before, so I'd be really interested to find out what's happening in that side of the market.
The personal individual buy-to-let market is suffering at the moment in that they're getting hit from every angle. Touched on the borrowing must be down across the board 65-70%. Then they brought the portfolio landlord rules in. So is there the same choice? Is it the same number of lenders? Yes. Is there the same choice for the individual personal buy-to-let landlord? No. So the likes of Virgin, Santander, you've got more than 4 properties, you're not going to be able to borrow off them. Have rates come down? Yes, slightly. I would have thought they would have come down a lot more to try and encourage a larger pool of lenders to come to them, or, as you say, fighting over the scraps. Not seen as dramatic as what I thought we'd see. I think that market will serve the type of landlord who is the lower rate taxpayer. You might have 2 or 3. The seismic shift is definitely over to the limited company buy-to-let market.
I guess maybe because the personal market is shrinking, it seems like criteria are easing up, perhaps. I'd be interested in hearing your experience on this, but I've seen a couple of news stories recently about, for example, lenders now being willing to lend to first-time investors who don't own a personal home already, whereas previously they weren't open to that. So do you think that it's actually loosening up a bit for the personal market because there's less business to go around than there was?
Yeah, they've got to find a way of lending. What you're referring to is first-time buyer, first-time landlord. Traditionally in the market is one of the hardest mortgages to obtain. It's easier to get an expat in Dubai mortgage than it is a first-time buyer, first-time landlord. The lenders are coming into the market. We've seen the likes of Precise, where we've gone first-time buyer, first-time landlord. The likes of Vida, first-time buyer, first-time landlord, and NatWest, who have always done it. So yes, I think you will see the individual buy-to-let lenders not loosening up criteria, but being inventive. Probably going for the type of lender that they traditionally didn't need to go for. So I think you're quite right in what you say. I think we will see quite new ways of getting money out of their bank accounts, shall we say.
Dave, so with personal mortgages, rates have gone down a bit, which is good, but generally the shift is to limited companies. I understand that. But what are the benefits to investors using a limited company mortgage? I guess rates are still lower. Is there anything else that would make you consider going down the personal mortgage route?
The big one there is tax. If you, as I touched on before, if you're a lower rate taxpayer, and by the way, I'm not an accountant, but if you're a lower rate taxpayer, it's probably going to suit you down the individual buy-to-let route. I mean, the thing is, it is now so important to speak to an accountant when doing your buy-to-let portfolio. We have higher rate taxpayers coming to us and are still attracted by the low interest rates in the market. Because let's face it, they're brilliant rates. They're the lowest rates we've ever seen in the buy-to-let market, individual buy-to-let market. I know they're very, very tempting, but if you're a high rate taxpayer, what's the point sticking in a limited company? I would suggest that the circumstances would fit the person on the lower rate tax bracket, and possibly the chappie who just wants to do 1 or 2, just wants to keep 1 or 2. I think once you get past that number, then you're starting to look towards the limited company buy-to-let route.
Bit of a random one, Dave, but I remember when your average loan to value for buy-to-let mortgages during the last boom were 85%. That was standard. And I remember after the crash, it was like 60% was the new average. Then it was 70%. And now we're at 75%. But it's been at 75% for a few years. Do you think with all this competition, we might see that loan to value move up, or affordability ratios will not allow that to happen? Do you see any changes there? I'm just interested to get your viewpoint on that.
We have already seen changes with an upward trend of LTV. More so in the limited company buy-to-let market. Paragon just released a product at 80% LTV. KRBS have always had a product at 85% LTV. If it wasn't for their product in the market, I would probably suggest that 80% is where we would stop. However, because there is an 85% LTV in the market already, I wouldn't be surprised if the likes of Precise, maybe not TMW, maybe not BM, but are more niche lenders, Keystone possibly, Foundation Home Loans, those type of people will have one eye on what Kent are doing with their 85% LTV. And I wouldn't be surprised if they followed suit as I say, I can't see the big boys doing it. The likes of VM Solutions and TMW, I think the recession is still fresh in their mind, and those guys got hit very, very hard. But yeah, I can see the niche ones doing it. I really can, going up to 85% LTV. Again, how that will pan out with regards to portfolio landlord laws, which have come into play, I'm not entirely sure, because that would mean that when they were stressing the client's portfolio in the background, they would have to have a more rigorous test, I would have thought. But I can definitely see the products coming into the market, Rob. So I can definitely see them coming in.
So clearly, there's so much going on in the mortgage market, so many products, like just off the top of your head, you've reeled off all these different rates and products and criteria. So hard to do it yourself. Working with a broker is clearly very valuable. But how do you know if your broker is giving you the best advice and they're telling you about the right products? Clearly, your broker knows more than you do. That's why you're working with them. So how do you make sure that they're doing as good a job as they should be for you?
Good question, Rob. If it was myself, how would I investigate? Well, I would investigate the company first and foremost. Make sure that company has a good reputation. Speak to the broker. What experience has he got? You know, some of the larger estate agents, they go through brokers at 10 to the dozen. You know, they're shipped out and go on a 5-day training course to get their CMAP qualification, and then plopped in a seat and told to advise. You know, like I tell my staff when we train them up, you know, you see your CMAP is, well, it's like passing your driving test, really. You know, you really start to, you know, you pass it, but you're learning all the time. So experience is definitely one way. One thing which really gets on my nerves within the industry is that it's a big world out there, the mortgage brokering world, and there are advisors and there are mortgage sales consultants. And I would consider my company to be mortgage advisors. Mortgage sales consultants are going to be driven by commission. They're going to be driven by high targets to obtain the level of lending which the company may want. In my mind, what I would be asking, if you are so bold enough, is to ask what the commission structure is. So within my own company, our commission structure is based not on monetary value. And I learned this working for the big banks. I saw how if you had a monetary target, that led you astray from giving best advice. So with my company, you are targeted on service, speed, so that's application to offer, and compliance. So they're the three important areas for me. And it doesn't matter if, you know, that member of staff makes £1 for me in that month. As long as they hit those three areas, then I'm happy for that. And do you know what? The other one, and this is going to sound strange, it may sound like I'm putting things in my favour, but if you are charged a broker fee, in essence, that could possibly be a better way of doing it. So our broker fee on average is around about £499. £499, maybe £750, depending on what part of the country you are, down to £300. But there are some lenders out there, I'm not going to mention names, who offer a fee-free service, which you think, brilliant, it's absolutely fantastic. But think on that company has to make its money elsewhere. So the way they do it, or the way these companies do it, is that they will try and sell you everything under the sun. So one prime example of that is that I had a client who had gone to, let's say, one of the larger companies, because it was fee-free. When he'd come to me, he'd bought 2 buy-to-let properties, and he'd been sold critical illness cover and life insurance on both of them. There is no need for that, you know. And I said, why have you taken out? He said, oh, they strongly advise that I do it. And I said, cancel it, because I don't believe you need it and you're wasting your money. So what they will try to do is they might entice you in with fee-free service, but don't be so naive to think that they're not out there to make the money. So it's probably the best advice I can give on that, on how to get best advice.
Absolutely agree. Something Rob and I have said before is, far from being put off by fees, is actually be encouraged when you are charged them. It sounds crazy to be encouraged that brokers charging you a fee is a good thing, but it's just what we've seen as well, Dave, and it really echoes the point you've made. Finally, we've covered a lot. We've looked at limited company mortgages in 2018. We've looked at personal mortgages. We've asked you a few bits and pieces. But what would you like to round up on? What advice can you give our listeners in 2018 around mortgages? What do they need to be aware of? What are best practices? What are the trends? Can you sum up the key points that people need to take away to be effective property investors in 2018?
Yeah, I think, doing a brief recap on what we've already said, keep your eye on the market for new products. Keep your eye on the market for the rates. I think the rates will slightly come down, but I think we will see a period of stabilisation, maybe for the next 12 months. If you are looking to start purchasing or continue purchasing, make sure you're going with a lender who's going to give you a service, as opposed to don't always look at the top interest rate. It may not be the best course of action. So i.e. you're looking to buy a property, you might be in a contract race, what's the point of going to that lender who's going to take 2 months as opposed to the one which is going for 6 weeks? You've got to keep an eye on this portfolio area. I would suggest speak to your broker, find out what's going on, because we are in a state of flux and have been for the last 2 years within the market, because we're seeing so many changes. Get in touch with the broker or get in touch with your lenders and keep an ear to the ground.
Well, we will absolutely be keeping our ears to the ground. And as things develop in the mortgage market, we on the Property Podcast will keep you up to date. Mortgage is so critical for property investors. Even if you are working with experts, you should still be aware yourself of what's going on and what's happening in the market. So we're here to help you with that. Expect to hear lots more about mortgages throughout 2018. Okay, Robert, is that part of the show where we like to read out a 5-star review? So who's been saying nice things about us this week?
Well, thank you to Unhappy Sav, and let's hope we've made him happy. Let's see what he says. I've been meaning to review for ages, but wasn't sure how to do justice to something that's this good, informative, and enjoyable, yet free. Normally on other property podcasts, there's a money-making angle, but not here. Rob and Rob are better, more informative, and enjoyable than all the others, but there's no angle or hard sell for lucrative courses. I don't get their motivation and reasons, but this is essential listening for any property investor. Well, thank you, Sab. Well, our motivation is we enjoy it and possibly like the sound of our own voices. But of course, the main motivation is these lovely 5-star reviews you keep leaving and all the kind words that people just keep sending us, whether email or through the social medias or through the reviews. It's awesome and we love it and we will not stop.
Okay, resource of the week time. And this is one that we could practically have used in London over the last couple of weeks. It's been blimmin' freezing. But Rob, you used it further afield recently and found it really helpful. So what is it?
It is Ski Tracks. Awesome app. So I managed to nick a weekend away recently skiing. And we went with some friends. And one of those friends recommended this app before we got started. Now, I love skiing. It's absolutely amazing. Anybody who skis, will understand the love I have for this sport. But this app, for me, just made it even more enjoyable. 99p, absolute bargain. What it does is it records how far you've skied, your altitude, where you've got up to, the duration you've been skiing for. It knows how many runs you've been on. Then it tells you things like the steepest slopes. You can then see a map of where you've been all over the mountain range. You get different graphs. You can also link in photos, and each time you finish the day, the photos are linked to that particular activity. But the one I love the most, because I am competitive, is your maximum speed. So I was able to compete against myself to see what my maximum speed was and set myself new challenges throughout the weekend to see if I could beat my PB. It makes it so much more enjoyable. Now, you don't have to be competitive to enjoy this app. You might just love all the data and all the rest of it gives you. The big thing for me, though, is a lot of these apps burn up your battery really quickly. I don't know how, but the way this app's built is it's very low battery use as well. So you've got confidence that you can leave it running in the background all day and it won't destroy your battery. So you can actually run it all day. Great app for 99p. If you're going skiing, snowboarding, then absolutely get this app. It's awesome. Highly recommended. And it is that time of year where I know a lot of people will be going away. So hopefully you find this useful.
And if you're not going away, don't forget that next week is Meetup Week. Yes, it's coming around again, the first Thursday of every month. This time it's actually on the 1st of February. So wherever you are in the UK, there's bound to be a meetup near you. It's completely free. They're great. Just go over to thepropertyhub.net/meetups and get your ticket for next Thursday.
So we'll be back next Thursday with the main property podcast. But before then, you know by now, we'll be back on Tuesday with Ask Rob and Rob, where we've got our tax extraordinaire, Russell, on. But remember, we're not just going to do tax episodes for the rest of the year. If you've got your question about property of any subject, mortgages, tax, refurbs, HMOs, whatever the subject, if it's property related, there's a good chance we can give you an answer. So to get your question in, go to thepropertyhub.net/ask and get your question in to us there. We'd love to feature you on a future show. But until we're back on Tuesday, it's bye for now.
Bye-bye. Thanks for listening to The Property Podcast. For show notes, all our past episodes, and to leave a review, go to thepropertyhub.net/podcast.